Hello. Today we're going to handle the first section under the language of management. So this section, the first part that we're going to talk about today, really relates to how you communicate within an organization to gain support for some of the different initiatives and ideas that you would have. If you get a quality role in one of the larger organizations, you'll spend your time, right, examining what's going on and then trying to drive behavioral change. And one of the things that is a result of trying to drive the change is you're going to be asking other groups and management level, particularly, to make investments on certain things, right? So to pay for additional trainings, to invest in new tooling, to make investments in new process changes, things like that. In order to be successful in doing that, you need to be able to make a good financial case for why this makes sense for the organization to do this. So, in order to do that, it's important to understand how businesses kind of keep track of things financially. We'll talk about some of the major statement types and then some of the major ratios, because most of the things that you're going to do is going to have an effect on certain parts of the financial picture of the organization. And it's important to know where those things are going to lay out. So basically, organizations work off of three basic statements. You have a balance sheet, you have a P&L or an income statement, and then you have some kind of a cash flow. We're going to talk about all three of those. Now, in the actual live discussion section that we do, I'll spend more time in detail going through each one of these. I'll go over them much quicker during the course of this particular talk. And then we'll talk about the variety of different ratios that are used to keep track of some key facets of the organization. So starting with the income statement. An income statement is a way to look at the money you bring in versus the money that needs to go out. And it's independent sort of the staging or the timing of it, other than it's usually for a specific period of time. Usually do an income statement for a quarter. Small businesses will often do the monthly, but really the quarter is kind of the big thing that you're looking at. And you take all of your revenues, your revenue streams, from those expenses come out, and what's left, hopefully, is profit. Now, here's a quick look at an example of an income statement. Your top line, which you probably heard that expression, top line revenue, that's basically the money that you get for whatever it is that you do in your business. From that comes your cost of goods sold. Cost of goods sold are direct costs that are attributable to the business that you're doing. Give you an example. If I produce mobile phones, the components and the screens and all of those other things that I buy from various different suppliers to make those phones, that's cost of goods sold. What I pay wages for employees or rent for facilities that I'm in or telephone expense or things like that, those are not cost of goods sold. Those are expenses. And the differential between the two really is your cost of goods sold is directly proportional to the amount of business that you do, specifically like piece count stuff. Your expenses, right? So like your rent or your wages or things like that are not directly proportional to the volume of the business that you do. Generally speaking, you would try to have your expenses in line with the kind of capacity in the business that you're doing, but it isn't a direct one-to-one relationship, whereas you'll find with cost of goods sold, it is a direct one-to-one relationship. When you take your cost of goods sold from your revenue, you're left with your gross profit or your margin. That's one of your first big ratios that's important, which is basically your gross margin contribution. Out of that money, all of your expenses come, okay? After your expenses are taken away, you're left with essentially what would be profit. It's often referred to on income statements as EBITDA, which is earnings before interest, taxes, and dividends. It essentially is the same thing. Out of that money, though, after that is you would have taxes, you would have interest on certain kinds of vehicles, not necessarily, sorry, not vehicles from the standpoint of like cars or trucks, but different kinds of investment kind of vehicles, dividends, so on and so forth, would come out of that. The next one I'm quickly going to talk about, and again, we'll spend some more time looking at this, is the balance sheet. Now, the balance sheet you would do less frequently. It's usually once a year. It's a snapshot in time. Frankly, all of these tools are snapshot in time tools, but the balance sheet doesn't usually change dramatically from 1 month or 1 quarter to the next. It's kind of like a year-to-year view. Some businesses, there'll be more dynamic elements on their balance sheet. It kind of depends on the business that you're in. In most cases, not overly. The sheet is, or the tool is set up basically that it shows you on one side what you own, which is referred to as assets, and the other side what you owe, which balances the two off. Assets are usually broken into long-term and short-term assets. Long-term asset would be a license that you had, or a source of royalties from intellectual properties that you had, things like that, that are longer term. Property, like real property that you own, buildings and land and things like that, could be on there. Most assets for most businesses tend more to be short-term assets. So cash that you have on hand, and if you extend credit terms to your customers, the accounts receivable that they haven't paid when you close the books off at the end of the year. So when you take that snapshot, in this case in December 31st, presumably there's some customers that you've shipped products to that haven't paid you yet. That money that they haven't paid you yet would show up as an asset on the short term. The liability side is usually the one that's more active for most businesses. It's money that you owe. And again, broken up between long and short term. Longer term tends to be things like loans. Shorter term is credit cards, HST, GST, right? Most businesses you have to collect. Net effect as you end up collecting for HST that you have to submit to Revenue Canada. You do that every quarter. Again, there'd be some portion of that would have been accumulated when you kind of took the snapshot at the end of December. So there would be some of that there. The way that you balance off those two sides, because inherently they don't necessarily balance off, is through the shareholders' equity. So this is basically from a owe and own perspective. What is the shareholder own? So what is the value of that organization to the shareholders? And it's not uncommon, certainly early on in a business, that your shareholders' equity is probably negative. So usually when you first open, you owe more money than your assets. And most businesses are not asset rich anyhow. There are exceptions, but an awful lot of them aren't. So usually what happens is the goal is to reduce your liabilities as the business grows, and as you start developing, you're not necessarily adding to the assets in any meaningful way. It's usually much more about reducing and controlling the liabilities, and enough of that happens that your equity number starts to go up. It's not the only way you would value an organization. It's part of the view. How important that view is has an awful lot to do with the kind of business that you do. If you're like a regular retail store or something like that, your balance sheet is not as important a tool in determining the value of your business, because you're not an asset-rich business, right? You've got leasehold improvements in the facility that you're in. You have inventory that you purchased, right, for resale and things like that. You'll have some equipment that you put in place and a bunch of other things like that. But you're not an asset-heavy business, or you certainly shouldn't be in that particular category. It's much more about your profitability. It's much more about your inventory turns. It's much more about things like that. However, if you're a business that I own a series of buildings that I rent out to tenants, then you are a very asset heavy business. So your balance sheet would tend to, relatively speaking, be a little more important in the view if somebody was looking to purchase your organization. The last one that we'll talk about is cash flow. And cash flow comes from the representation of inflows and outflows don't match. certainly they don't match in a time from a time standpoint. Usually your rent is due at the beginning of the month, right? So your rent is due at the beginning of the month. Credit card statements are often kind of mid-month. There's other, ongoing obligation payments that you have that kind of come due at specific points in time. Your revenue that you actually get for the business that you do will come in over the course of that particular month, but it isn't necessarily even, and it doesn't necessarily match what the outflows are. So a cash flow is all about managing inflows to outflows, not only from a how much standpoint, but also but from the timing standpoint. So when do I have these things come in, and when do I have these things going out? And as I said, I'll go into a little more detail about some of these tools when we're doing the live session, because I think it's important to really understand the value of these views and kind of inherently what they show you. So each of those statements show you the same organization. They're just different angles that you're looking at it from, right? So one of them is about what do you own versus what do you owe. Another viewpoint is about money coming in and the various different costs that you had in getting that revenue, both your cost of goods sold items as well as any of your expense items, and what's the profitability left after the fact. And cash flow is all about managing not only the amount, but the timing of incoming flows of money and outflows to pay rent and wages and so on and so forth. As I mentioned, this first one, so your gross profit margin is a ratio that shows up on your income statement. It's your revenue minus your cost of goods sold. It is a very, very important number. And the margin is relative to the industry that you're in. There are some industries that are relatively higher margin industries. There are some that are relatively lower margin industries. Just because it's a higher margin industry doesn't necessarily make it more profitable. There are different things you can do, and how you do those things change, and kind of what practices you follow or strategies that you pick will certainly vary depending on the business that you're in. And there are some tools that work better, like promotional tools that work better, depending on your margin structure. So I'll give you an example. I mean, your traditional soft goods retailer, so, sells clothing and things like that, tend to be fairly high margin businesses. They're usually, even after you do sales and so on and so forth, you're probably best part of 50% gross margin, which means of your revenue, half of your cost of goods sold is that number. So the other half becomes your margin, right? So 50% margin is not bad. In some cases, it's even higher than that. In fact, normally it would be higher than that. That business is one that you often drive incremental business by doing sales, right? And sales is I reduce my price on something to get people to buy more. And when I have a sale, I give up some margin in order to drive top line revenue. I also add some expense in communication and advertising and stuff like that for the sale. The reason that I would potentially do that is because the higher revenue that I drive, even if I get slightly less margin on those sale items, will be more than compensated for once it gets to the bottom line. And I'll cover this in a little more detail when we do the live session. So margin's a big thing. Now, some businesses are not high margin. Grocery business is not a high margin business. It's in fact single digit usually. Those businesses are all about volume. So the things that you do are different. And yes, they do sales, and they do have flyers that go out every week that you get in the newspaper and stuff like that. But if you look, relatively speaking, the money off is not anywhere near as high as you would normally see in traditional soft goods. And actually in the grocery trade, a portion of that, if not all of that, is actually paid for by the vendor, not the retailers themselves, right? It's one of the reasons why, if you look, the grocery business is a business that basically is dominated by big players, because you have to have a fairly scaled organization to kind of make it in that space, unless you specialize in a niche, right? And there are some niche, grocers. They tend to be higher end. They're not trading on price competitive. They're trading on, access to things that you wouldn't normally get in the regular grocery stores and stuff like that. So they kind of trade into a different space. But if you look, the overwhelming the industry is populated. In Canada, it's either stores that are related to the Weston company, so Loblaws, Zayre, stuff like that, or Sobeys. And that's pretty much it, right? And as I said, there are a few independents, but even the discount ones are all part of those families. Okay, another one is turnover, inventory turnover. So your inventory is an asset. It does show up on your balance sheet, but again, it's a static snapshot in time inventory that you're doing, right? So right on December 31st, what's the value of the inventory at that point in time? Inventory is money tied up in another form. It's also probably only ever going to be worth less money than it is when you buy it. And that's because stuff goes stale, or things get damaged, or customers change their mind about things, so you no longer need certain things. Like, there's always something that seems to happen that diminishes away, for the most part, usually at the value. It's one of the reasons why a good business rule is to keep as little inventory as you can reasonably get away with. If you have too little, it will impede your ability to do business. But too much of it is a risk, and too much of it actually takes money out of your organization that you can't use to, pay rent, pay wages, pay a variety of other things. So turnover is this concept of how many times does your average inventory turn over during the course of a year. So if a normal operation to do $100,000 worth of business, I need, $10,000 worth of inventory for a year. I can buy it once at the beginning of the year, work my way through it. That's one inventory turn. Or I can buy it 10 times throughout the course of the year. That's 10 turns. In one way, I'm using up to $10,000 at once, right? And then progressively, working my way through it over the course of the year. Another way, I'm not using any more than $1,000 at a time in order to be able to fund it. So you can see that makes it a lot more efficient, right? Now, there are some real practical limits for how many times you can turn your inventory, because there are transactional costs that are related to purchasing and shipments and a variety of other things. But just without going into significant details, generally speaking, higher inventory turns are better. It gives you better velocity of the money in your organization. It frees up more cash to allow you to do other things. Things that positively affect your inventory turnover will be very well looked at. Same as things that positively affect your gross margin will be looked at well. When you're keeping your books, so any of those statements, there's two ways you can do it, really. There's the cash basis or the accrual. It all comes down to how you do business. So if you do business in such a way that I provide a service to somebody and they pay me for that service when I've rendered that service, that's a cash basis business. Basically, you're recognizing your income when you've actually done something, and when you've actually got paid for it, right? And really, the cash to accrual basis is really about how you recognize revenue and when. It doesn't change the overall numbers. It's just it really has to do with the timings of it. Accrual basis is, I would do stuff and I would ship it to customers and I would be, done my transaction, but they pay me 60 days later, or so on and so forth. In which case, where I recognize revenue is when I've completed the order and shipped it. So often it's the shipping terms would be FOB, like my dock, for example. So FOB is free on board. And basically, when it leaves my dock, title to the goods transfer to the customer. So at that point in time is when I would recognize revenue, not necessarily when they paid the bill, right? So it kind of separates those two things out. Not a big deal. You would only set this up once. And as I said, really which way you would do it would be a product of kind of how do you do business. And it would, in a lot of cases, it's driven by convention in the industry. Another biggie is return on investment. And you've probably heard this term before. So ROI is basically all about the net dollar benefit over how much you had to spend to get it. And it's reflected over as an amount of time. So we figure out that if we invest in this new machinery, it will make us more productive, okay? So how much is the machinery? So let's say it's $10,000 investment. How much more effective does it make us? Well, it's supposed to make us $1,000 more effective every month. So I had to spend $10,000. It's going to give me $1,000 worth of benefits every month. Therefore, my ROI is 10 months. Okay. So basically, it takes 10 months for me to get my initial investment back. And after that, anything incremental to that is extra benefit to the organization. Okay. Big important concept. Shorter ROIs are very easy to say yes to. Longer ROIs are very hard and often don't make sense to. I'll go into more detail when we do the live discussion for this, but just basic rule of thumb, ROI you want short, right? So when you're pitching, the investment in training, the new machinery, the whatever, right? That's part of the job. Things that positively affect the gross margin will be well received. If you cut waste, like material waste is in your cost of goods sold already. So if I waste less, it reduces my cost, which will improve my margin, right? So less waste gives you better gross margin. From an ROI standpoint, shorter ROIs are good investments for an organization because you'll have a much longer tail that you'll be able to reap the benefits of whatever that activity was that you did. So when you're selling these concepts, when you're selling these things that that we've identified, they're important things for us to do to improve the quality, work, on many of those different dimensions of quality in the business, you need to understand how to communicate them, particularly to management or people in finance. And that's understanding where's the money that I'm asking you to spend today, where does that show up, which is usually an expense, right? Which means that you'll take a hit on that income statement for the period that you're actually spending that money. However, if it has a positive effect of reducing waste, that will increase the margin of the business. If it has a fairly short ROI, there'll be a significant improvement in the flow of money into the business as a result of it, right? So that's another good thing. You also need to have some sense of talking about risk, and we'll talk more about risk in the second section of this. But there's always some risk, and that's one of the things with particularly with ROI. In the shorter ones, there's fewer things that change. The longer the ROI, the more things that can change. And what happens is ROI is an estimation. Hopefully it's a fairly accurate estimation, but still an estimation. Like you're estimating in the future, it's going to give us this value for whatever length of time. Maybe it does, maybe it doesn't, right? And that's why the longer out that they are, the more problematic they are to accept, because there's lots of things that could change in the meantime that would nullify the value of that particular activity.